What's going on, everybody? Brett Swarts, Capital Gains Tax Solutions. Does 100% of my capital need to go into the Deferred Sales Trust? That is the subject of today's video and podcast. Hey, for those who are wondering, we help people defer capital gains tax. So on the sale of highly appreciated assets, cryptocurrency, businesses, so you can create and preserve more wealth. By the way, the DST, not to be confused with the Delaware Statutory Trust. That's just another form of a 1031 exchange. You can see that in my other video series, the 1031 exchange versus the Deferred Sales Trust, and why the Deferred Sales Trust is like Netflix versus a Blockbuster. But now let's cover the topic at hand. Does 100% need to go into the Deferred Sales Trust upon sale? The answer is no, it does not. To the extent that you are willing and able to pay tax, you are able to receive capital at the close of escrow, at the close of a transaction, or a payment shortly thereafter, and just pay your tax. And I'll give you an example of this. We had a client who sold a large asset, a primary home in the Bay Area of California, and they wanted to put a portion of that asset into a primary home. And so upon the sale, we were able to schedule a payment shortly thereafter, and they paid tax on that amount. And then they are able to put that for the down payment for the house. And so the biggest thing to understand with the Deferred Sales Trust is whatever you want to spend personally, it's going to be taxed. So whether that's a distribution where you're using it on, just regular living expenses or traveling or your primary home, anything that's basically personal use becomes taxable. But anything that's in business purposes, as long as it remains in the trust, remains in a tax deferral state. And so such as going in stocks, bonds, and mutual funds, cryptocurrency, businesses, real estate, that's investment real estate. The Deferred Sales Trust is a great way to defer the tax, but along the way, you might or need or want some income. Of course, most of our trusts are structured in a way where there's income coming out immediately starting in month one, where people are taking payments from that, and you'll get a 1099 INT for any interest payments that you've received. And anything that's dipped into principal amount, you'll get capital gains tax on that, treatment on that. And so just know that the Deferred Sales Trust is flexible, and you're taxed as you receive payments. And you're absolutely welcome to sell an asset and not have to put 100% into the trust. In other words, you can just have a distribution made, typically within the first couple of days at the close of escrow from the trust to you, where you pay tax on that. So if you want to learn more about the Deferred Sales Trust, you want to get started with an exit plan, you want to compare it against 1031 exchange, opportunity zone, charitable remainder trust, traditional or regular Delaware Statutory Trust, we are happy to help you. In fact, you can go to capitalgainstaxsolutions.com, schedule your no-cost consultation call. If you have a $1 million net proceeds, $1 million gain, it's got to be big enough to make sense. And if you are looking to defer the tax and not just spend it all, like we said, and then that's taxable. So those are the key things there for this video and this short podcast. If you want to learn more, you can go and check out my book that's coming out soon, Building a Tax Deferred Exit Strategy, and it talks about kind of the inner workings of the Deferred Sales Trust and kind of the details to learn more and more about that. Go to capitalgainstaxsolutions.com. Hey, thanks for watching this video. Please subscribe to the channel if you haven't already. Please hit the like button on the video. Please share this with someone who can encourage. So appreciate everyone with you. Thank you in advance for doing all that. And we'll talk to everyone again soon. Bye now.